Grade 8. So just a quick accounting concepts and then classification of accounts. Extremely important to start here. If you are struggling with this, then it means that you will most probably struggle with your counting equation, and then you will struggle with your trial balance as well, and your general ledger moving forward. So it's important to note that we have three different classifications within accounting. We have assets, so those are all the things owned by the business. So we have purchased some vehicles, we own the vehicles whenever we purchase it. Your money is hopefully yours until you decide to give it to someone else, so another asset. So anything owned by the business. Then, if we look at liabilities on the other side, we are looking at the things that the business owes to someone else. So something that the business has to pay to someone else, such as a loan that you obtain from a bank. So at some point, you are going to have to make repayments. It's not your money. Then, right in the middle there, we have owner's equity. So, we are going to say that the owner is going to contribute money towards this business to help the business to start. And then, if the business maybe has some shortfall somewhere, the owner will then give more money. That is capital. The owner can at any point then say, you know what, I need some of my money back. If the owner decides to decrease his capital, he can do so. But he can also tell the business, you know what, I actually just want you to pay some of my expenses on my behalf. And that is going to go to drawings then. So when the owner gives money, it's capital. When the owner takes some money out of the business, not capital, something else, then it is considered drawings. And then the reason why the owner has now started this business is because the owner wants to make money. And in accounting, we are going to refer to that as the owner is making a profit with this business. And profits, you learn about this in grade 7 EMS. Profit is income less expenses. So all of that is going to go to the owner. Therefore, we can say that whenever the business generates more income, the owner's equity is going to increase. Whenever the business has to pay expenses, owner's equity will decrease. And the reason for that is the effect of these transactions on the profits. And profits go to the owner. And owner's equity is going to increase the more profits that the business is making. And there we have quite a few examples. You need to please study these until you get a better feeling about when is something an expense, when is it an asset. So remember, assets, something that the business owns. We are going to use it for at least 1 year, but definitely longer as well when we're looking at something like, for instance, vehicles. You're not going to necessarily sell your vehicle after 1 year. And then when it comes to expenses, we are going to say that are the things that we have to pay continuously to be able to use. Like, for instance, your water and electricity. You pay your water and electricity. You then do not own ESCOM just because you paid your electricity. You have to pay them for the units that you use. Once you have used those units, you have to buy new units. So it's not something that's going to last long. Once you have used it, it is done. If you think about the petrol that your parents have to pay for just to get you to school, once you have made that one trip to school, that petrol is gone. Then they have to replace the petrol. One that I see quite often that grade 8 struggle with is salaries and then wages. Remember, the business does not own their employees. Therefore, you cannot include your salaries and wages in your assets. Those are expenses. If you do not pay your employees, they're not going to stay. They're going to go. They get paid for the work that they have done. So please do not include them in your in your assets. Right, so then when to debit, when to credit? That's usually a big question. And for that, we are going to use debt click. So we are going to say that in our debt accounts, we have drawings. That will change now. We have drawings. There we go. And then we have our expenses. And we have our, did it not do that correctly? No, it did not. Okay, so we have drawings. I think I added my expenses to debt. Our expenses, our assets, and then debtors control. So debtors control is something that you will learn about a bit more in grade 9, but those are people who buy from you, but they don't make payment immediately. So it falls under assets, but it just helps debt click to actually work out. So they are your debt accounts. Then click on the other side is capital. So capital, and then we have loans, and we have income, and we have creditors control. Creditors control, once again, one of those accounts that you will see in grade 9. This is now when you purchase from someone without making immediate payment. So you are buying on account. Okay. So what this means is that whenever the owner withdraws more money, it's more drawings. Whenever we pay more water and electricity, it's more expenses. Whenever we buy a new asset like land and buildings, we have more land and buildings. So the debt accounts, whenever we have more thereof, it will get a debit entry. And because it increases on the debit side, it also has its balances and totals on the debit side. Then if it decreases, like for instance, I'm now using my money, my asset, to pay for something, it's going to decrease on the credit side. Okay, so debt accounts increase on the debit side, decrease on the credit side. Click accounts will then increase on the credit side and decrease on the debit side. In other words, every time that the owner contributes more capital, I have more capital as a business, therefore I will credit my capital. So let's look at that, for example. Owner increased his capital contribution by 800,000 Rand by means of a direct deposit. Right, so that's our transaction there. Now, the question is, what is the account debit? What is the account credit? Your first step is to identify the two accounts involved in this transaction. So the owner increased capital. So we have capital, that's an account. And then this was done by means of a direct deposit. So in other words, the business received money directly into their bank account. So bank. So we have capital and we have bank. So the owner has now increased his capital. Therefore, I'm going to credit capital, right? Because credit capital means I now have more. I've increased that. And then the other account is bank. Bank is an asset. So I will also increase my assets. Therefore, I'm going to say I'm going to debit bank with 800,000 Rand. And I'm going to credit capital with 800,000 Rand. And there we go. That is basically what we are doing here with the debt click. It just helps us to remember when something increases with a debit and when it increases with a credit. And we are also going to use this when we are doing the trial balance. So trial balance is just a summary of all the transactions, all the accounts within a business. So you are going to go through your accounting cycle where you're going to start with a source document. You're going to take that source document, then you are going to record that in a subsidiary journal, such as the cash receipts journal. Then once you are done with all of your subsidiary journals, you will then summarize all of those transactions in a general ledger. So per account, you will show what happened within that account for the year. For instance, bank, you want to see how much money did I have in my bank account on the first day of the month? What was my total receipts for the month? How much did I have to pay? and how much do I have left. So that is a summary of the account. Then, if you only want to see what was my bank balance at month end, so only the balances and the totals of each one of the accounts, that is going to be in your trial balance. So the trial balance is a summary of all the balances and totals at month end of your general ledger accounts. So we have two sections. We have the balance sheet section accounts, and we have the nominal account section. So the nominal account section is going to be your income and expenses, right? Those are your nominal accounts, and they have totals, not balances. So totals, because I'm trying to calculate my total profit for the year. Okay, so totals. And then our balance sheet section accounts will then be our assets, our owner's equity, and our liabilities. Okay, so obviously then owner's equity excluding nominal accounts, excluding the profits. And these accounts will have balances because I'm carrying the balance with me. Like, for instance, my bank balance. I'm not just going to throw the money away at the end of the month or at the end of the year. I'm going to take that with me into the next financial year. So we're going to start our trial balance with capital. So owner's equity goes first, and drawings. Then you're going to list all of your assets. Let's say you had land and buildings, and vehicles, and maybe some bank, because how are we going to trade without money, right? And then you will list your liabilities, for instance, loans, and in grade 9 onwards, you can have your creditors and so forth. Then nominal accounts for you guys, it's current income. Whenever you render a service, could be that you maybe earn some commission on other things that you did for other businesses. And then you are going to start by listing your expenses. Maybe your bank fee, seeing that you have a bank account, could be that you needed some cleaning materials. Maybe you had some rent expense. So remember, you must say rent expense. You can't just say rent, because rent income is also an account that we have. And maybe some water and electricity. Okay, so all those different expenses that you can have that you will list there. Then in the end, when you now have all of your accounts listed with all of their balances and totals, your debit side must always be equal to your credit side. And that is because we have a double entry system in accounting, where we say that for every debit, I must have a credit. And that's why we can say that the trial balance must be equal at year end. So then folio means reference number. In other words, where did I get this information from? And remember, I said the trial balance is a summary of the general ledger. So whatever the ledger account is, that number will go into folio. So for your balance sheet section accounts, those accounts will start with a B, just to say it's a balance sheet section. And then it will just go B1, 2, 3, 4, 5, and so forth. Okay, some teachers prefer if you have specific folio numbers always for certain accounts, but it's going to differ depending on the business that you are working with. Then when we're looking at the nominal section, for them, you will have N1, N2, N3. So nominal account 1, nominal account 2, and so forth in my general ledger. Then when it comes to the debits and the credits, this is now where you can use debt click, because debt says all debt accounts have debit balances. They increase on the debit side, therefore their balances and totals are on the debit side. And debt included my drawings as well as my assets. So all of my assets, right? Then it also had, so that's D for drawings, and we have A for assets. Then we still need E for expenses. So you go and find all of your expenses. They will all be on the debit side. For you now, you won't have debtors control. That's grade 9. The click accounts increase on the credit side. Therefore, they have their balances and totals on the credit side. So capital was the first one. So click, then L for loans, and then I for income. And then creditors control, once again, that's grade 9. You will not be using that. And then you just enter the amounts that we gave you into these relevant columns for your trial balance to balance.